Hello, everybody. So today I want to talk about two stocks that are being, mistreated by the market, is to say the least. It's this earnings season has been brutal, absolutely brutal. I think it's because it's August. I think it's because of the algos. Let's get started. I just want to cover two of them. REAX, the Real Brokerage. It's a small cap that I covered before on the channel. I like it very much. And then I want to talk about the trade desk, and the trade desk especially is like having a bloodbath today. Anyways, for REAX, the drop, frankly, I find shocking. It's minus 4% on what? On perfection? I mean, this was a perfect report. REAX had a perfect report. Their thesis is the same. This is a company that has been able to grow agent count, revenue, adjusted EBITDA, transactions. They've been able to grow everything in the face of an ever tougher real estate market. Real estate is not coming back, and they're growing as real estate is not coming back, as there is so much sitting in inventory, so little of it moving. And REAX is really my play on the return of a real estate market. There are so many homes who are just sitting on the market who didn't sell last season and who didn't sell the season prior to that. And what do you think is going to happen to the real estate market once rates eventually drop in, I think, like worst case scenario, May 26? And so as a long-term investor, May 26, it's when we have the new Fed chair, Mr. Dove, when Mr. Dove comes on May 26, in May 2026, what's going to happen to the rates? Well, it's going to go very, very down. And then what's going to happen to real estate? Well, in my view, real estate will pick back up, and the system will just these homes will just flow. And a company that will greatly benefit from this, I think, is REAX, because REAX right now is focusing on building. Bear markets are for building. They're building their agents. What is REAX? Well, I tried to find a good way to explain it, and I'm gonna explain this like this. It's toast for realtors is the way I'm gonna explain it. Toast for realtors. What do? They are a brokerage, and they disrupt the brick and mortar brokerage, right? And so typically in a town, and realtors, by the way, they have to use a brokerage, right? In most jurisdictions, realtors have to use a brokerage when they do their business. And in most towns, it's small mom and pop shops, secretaries, a bunch of realtors, employees, lots of competition, local. And what REAX does is it allows these realtors to go on their own and to do business on their own with REAX. But REAX sets up everything on the back end for them. It sets up an app for them. Everything is handled by REAX. It's a brokerage that is, in my view, much better than the legacy brokerage, but it's also a brokerage that is national, and it's a brokerage, more importantly, and this is the most important thing, this is a brokerage that you don't have to worry about your commission. You don't have to negotiate your commission. It's 85-15% split on the commission. So the 3% that the realtor gets, and again, 3%, that's also coming down, by the way. So this is becoming more and more important as those 3% are coming down, and a lot of sellers are negotiating today, and they want to pay only 2%. But anyways, the typical 3% that the realtor takes, when you have a broker, the brokers make all of the money. Because when you have a broker, 30% is what the broker takes, and 70% is the cut of a realtor. Well, with REAX, which with this toast for realtor, with this app, well, it's 85%, 15%, 85%, 15%. So the realtor keeps 85% of his or her commission, and even better, after $12,000, you get to keep everything. So they've designed a system to attract top realtors, to attract the 80-20, to attract the realtors that do not need the mentoring anymore, that do not need, to have somebody holding their hands. Those realtors who are fully independent, who are high performers, they are attracted to the REAX platform thanks to the commission split, which is so good by itself. And that's probably a better alternative. If you're a top realtor, it's probably a better alternative than building your own brokerage, which is what some realtors do. And of course, the issue with real estate is the gross margin. The gross margin is not very good at 9%. If it could take it to 10%, but it's not very good. But it's okay, right? Because the revenue is excellent on this company, and even with this not so good gross margin and EBITDA margin, you still get an enterprise value over gross profit over revenue of a 0.11. And the rule of 40 is achieved out of 53. So this is a stock that is cheaper than, say, HIMS. And in their app, right, recently, they're moving into ancillary services. So this is a classic in real estate, trying to move to mortgage, trying to move to title, because mortgage is what, 45-50% margin, and title is 80% margin. So they're trying to offer their own branded services. They're also, that's why I call it the toast for realtor. They also help realtors with their banking, and you can get your card with Real on it. You can run your entire real estate operations on the Real app, which is why I call it the toast for realtor. And I came across this company, by the way, in my own neighborhood, because I saw two realtors who like had this kind of nice real thing. And anyways, it's I like this stock very much. I like that they've been growing in a very, very tough market, and I like that they are asset light. As you know, Open Door is not asset light, and Open Door, unfortunately, was killed by the Fed, because when you're not asset light and you have all of these interest rates hurting you, well, you're kind of in trouble. So anyways, this is real. So I don't understand why the stock is down. To me, it's business as usual. It's just algos doing their thing. But really, in many ways, you could take Real down 4% for a small cap like that with a good report. You could say this is a win, because you could have a good report too, but if you are not a small cap, if you're a bigger cap, you could have this. And this is what's happening to a trade desk. In 3 quarters, this is the second time this major drop happens to the trade desk. It happened in, I think it was Q4 or Q1. It happened a few quarters ago. This is the second time that this stock has like a 30+% move to the downside after earnings. It's like drop to 50, move back to 70-80. Drop to 50, move back to 70-80. Not saying it's going to do that again, but to me, this seems like an overreaction. The trade desk creators Q2 results, even though they beat, by the way, but they created on Q2 result, whatever, and that's mostly because of an analyst downgrade. Apparently, an analyst did like a 180. They had like a 130 price target, and they changed that price target to like lower than what it is now. So very rare to see an analyst do that. But they had a CFO exit, and maybe people were surprised by that. And algos must have coded, if CFO exit, maybe books bad or whatever, or maybe something bad, and therefore they just sell off. But to me, when I look at this company, I look at EBITDA margin. I find the EBITDA margin super satisfying. I calculated the EBITDA margin for this quarter, and this is not a typo. We're at 40% EBITDA margin for this quarter. So this company is a cash machine, and of course this is showing in the rule of 40, predicted to grow at 20%. Yeah, some people are saying it could grow less. Some people are saying, in my view, this company is fine. Again, the advertising space is not necessarily a space that I follow or that I even like, but it's a tough business, and they are kind of this neutral place for advertisers where they can go and bid on all sorts of stuff. If you're interested, go look my video. I made a video about this stock not too long ago. It's available on the channel. You can just search TTD and you can see my full analysis on this one. What I'll say is that despite the drop, this stock is still a little expensive per my spreadsheet at 0.61. Yeah, I mean, and it's not nosebleed, but it's a little expensive. And keep in mind that expensive valuation, in my view, is justified. Why is it justified? Well, let's go back and look at the past nearly 9 years of performance. You can see this is a stock that has returned 46% average annual return per year over the past almost 9 years. 46%. So you have more than doubling the NASDAQ on this one. And so, of course, a stock that has this historical performance is going to have a little premium. And at 54, you're still paying a little premium for it, right? Of course. And it's founder-led business, right? So anyways, so that's why quality, sometimes you got to pay up for quality. It's still a little expensive at 54. I am not buying this dip. It's still a little expensive. But if it were to drop like another 10%, or 15%, then I'd be looking into it. So anyways, this was not investment advice, not financial advice. This is only entertainment. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching and have a wonderful, wonderful day.